Good afternoon. Thank you for joining us for our discussion group webinar on Wednesday, June 11th, 2025. My name is Andrea Chung, and I'm a member of the CIM MES discussion group. Jackie Allison, chair of the CIM MES, will be assisting with this session. Today, we are pleased to feature Alexander Pizale and Maria Tapia, who will be presenting on the topic National Instrument 43-101, Approach to Multiple Economic Scenarios in One Technical Report. Alex Pizale is a partner in the Business Law Group and serves as the co-chair of the Environmental, Social and Governance, or the ESG group at Cassels, Brock and Blackwell. Maria Tapia is an associate in the Business Law Group at the same firm. A few words about CIM and MES. The Canadian Institute of Mining, Metallurgy and Petroleum is a not-for-profit technical society representing professionals from Canada's minerals, metals, materials, and energy sectors. Founded in 1898, CIM is comprised of 11 societies and has branches organized geographically into 3 districts across Canada: Western, Central, and Eastern. The Management and Economics Society, or MES, is one of the societies within CIM. MES members contribute to all aspects of the management and economics of companies active in the mining sector. Through events like this one, MES provides platforms for industry professionals to exchange insights and ideas on economic, management, and financial topics in mining. We welcome anyone to join CIM MES. We would like to thank our generous sponsor, IM Gold, for supporting this event. Now let's get started with today's presentation. We encourage audience participation. Should you have any questions during Alex and Maria's presentation, please type them into the chat. We will read them to Alex and Maria during the Q&A session following their presentation. Without further ado, I'd like to welcome our guest speakers, Alex Pizale and Maria Tapia.
Thank you, Andrea. Well, thank you all for joining us today to talk about approaches to multiple economic scenarios in one technical report. As the wording here says, an economic study and a tech report really should summarize the preferred or selected option for development and production rather than showcasing options or alternatives. However, there are situations where more than one scenario might be relevant or warranted, and we're gonna talk about that today. The devil is really in the details, and that's probably a theme that you're gonna hear over and over again. Yeah, so just to kind of kick off a bit of a disclaimer, this is for general information purposes only. We're not providing any legal advice to the participants. Again, if you're in these situations, just seek out your own legal advice. The situations can be very fact specific. The rules are very nuanced, and it's very important that you seek out the proper advice because a few different words could easily put you offside the rules. Again, this is really based on our interpretations, and we're by no means regulators, and nothing that we say here should be considered definitive. Also, as a heads up, we've been doing a 43-101 series. If you look on our website under my profile, you'll see we've got about 18 different alerts or episodes, topics ranging from voluntary filing reports, what issuers need to know about production decisions about feasibility studies or pre-feasibility studies, technical reports in M&A situations, royalties and streaming. There's, like I say, 18 different topics, all of interest. This is just one of those topics, but I encourage you to check out our website and the different topics, and by all means reach out if you have any questions.
Okay, so just a bit of an outline of what we're going to be speaking about today. We're first going to lay the foundation of the meat and potatoes of what we're talking about. So we're going to chat really quickly about the purpose and elements of National Instrument 43-101, as well as the different types of economic studies. And that will prime us to talk about kind of meat and potatoes of this presentation, which is what is the prohibition of multiple economic scenarios in one technical report. We'll then turn to the actual problem with satellite deposits and phased approaches when it comes to this prohibition and why you can't have that in one technical report. And we're going to also talk about a potential solution to this problem, rescoping advanced stage projects. And finally, we have a case study of what happens when things go wrong, and then we will turn to a Q&A session. So first, the purposes of NI 43-101, we won't spend too much time on this. As you likely already know, NI 43-101 is a rule adopted by the Canadian Securities Administrators, and it regulates how Canadian mining companies are to disclose technical information relating to their mining projects. The rule was adopted in response to a number of fraudulent schemes in the mining sector involving public companies. BRIEX, which is probably the most famous or infamous, involved the large-scale falsification of drilling and assay data. However, there were others, such as Naxos in '96, which involved fraud arising out of proprietary assaying, Timbuktu in '96 as well, involving salting, and Cardaway in '96 as well, which involved false visual estimates, among others, throughout the years. So in response, 43-101 was implemented in 2001. The instrument governs disclosure of scientific and technical information in order for this information to be presented objectively and in a consistent manner, which ensures information is more easily understood and allows comparison with other issuers' disclosure. Disclosure in 43-101 is broadly defined as any oral or written statement, written disclosure made by or on behalf of an issuer and intended to be or reasonably likely to be made available to the public in a jurisdiction of Canada, whether or not filed under securities legislation, but does not include written disclosure that is made available to the public only by reason of having been filed with a government or agency of government pursuant to a requirement of law other than securities legislation. So it really captures a very broad scope of disclosures.
So we'll talk about now just the elements of National Instrument 43-101. The Canadian Securities Administrator developed a set of national and multilateral instruments helping to foster a nationally coordinated and modernized security regulatory framework. The instruments are adopted as local subordinated legislation under each of the provinces and territory securities act. The securities regulators such as the OSC and the BC Securities Commission are members of the CSA and participate in the development of these instruments. Once a proposed instrument is in final form, the securities regulators deliver it to the Minister of Finance for review and approval. National Instrument 43-101, being a national instrument, has been adopted in all 13 provinces and territories. The rule itself is fairly short, and it sets the standards for disclosure of scientific and technical information related to mineral projects. Its purpose is to ensure the accuracy and integrity in public disclosure by mining companies. It covers topics such as what can and cannot be included in public disclosure, whether written or oral requirements, what are the written and oral requirements specific to mineral resources and reserves, who can author a tech report, and who can be a qualified person. The instrument is accompanied by a companion policy, which details the Securities Commission's views on how the rule is to be interpreted and applied, and a specific form that governs the requirements for the preparation and content of a technical report. It also incorporates by reference certain definitions developed by none other than the CIM. And there's also a number of CSA exchange, like TSX, TSXV, and other exchange presentations that help provide more context on certain elements of the rules. The stock exchanges generally also have rules of their own with respect to mining disclosure, but much of which is piggybacked off of 43-101.
Okay, so there are essentially three different types of technical and economic studies. So we have the PEA, the preliminary economic assessment, the pre-feasibility study, the PFS, and the feasibility study, the FS. An issuer is prohibited from using the terms preliminary feasibility study, pre-feasibility study, or feasibility study, or any of their acronyms when referring to a study unless the study satisfies the criteria set out in NI 43-101. So what are each of these? Let's start with the feasibility study on the right. This is a comprehensive technical and economic study of the selected development option for a mineral project that includes appropriately detailed assessments of modifying factors, together with any other relevant operational factors and detailed financial analysis that are necessary to demonstrate at the time of reporting that extraction is reasonably justified or economically mineable. The results of the study may reasonably serve as the basis for a final decision by proponent or financial institution to proceed with or finance the development of the project. The confidence level of the study is higher than that of a pre-feasibility study, so it's the highest level of confidence you can get. A reserve in a feasibility and pre-feasibility study might be an unresolved or permitting or tenure issue, negative economics, or issues with the geological modeling. It is not acceptable to fail to delineate a reserve because further exploration is needed. So now we turn to the PEA, the preliminary economic assessment. So this is a study other than a pre-feasibility study or a feasibility study that includes an economic analysis of the potential viability of mineral resources. Typically, the accuracy of a PEA is lower than that of a pre-feasibility study or a feasibility study, of course. Unlike the other two types of studies, a PEA may contain results of an economic analysis that includes or is based upon inferred mineral resources. However, where that occurs, disclosure based on the study must contain prescribed cautionary language, which is in 43-101. This is the only study that is allowed to be based on inferred resources.
Okay, so now time to talk about multiple economic scenarios in one report. Further to the last slide, the distinction of each of these studies is important to keep in mind. As a general rule, a technical report that includes an economic study of a property should present a clear, consistent, and defensible prediction and assumption about the future mineral production, regardless of the property stage, whether that be a feasibility study, a pre-feasibility study, or a PEA. Given the level of accuracy and specifics of each study, they're meant to be distinct, not merged, as that could create uncertainty. And a lot of the rules that have been set up in 43-101 have been put in place to avoid this uncertainty. Thus, there generally should not be more than one of these studies in one technical report, as it could be misleading and confusing to readers. It is prohibited to prepare certain aspects of a report at one level, but then others at a different level. Consistency is key. A technical report is supposed to summarize the preferred or selected option for the development and production, rather than showcasing options or alternatives. The rationale in the pre-development phase is that an issuer should be able to use the study contained in the technical report to demonstrate how it's going to proceed to develop and build the project, and to illustrate the funds required to achieve this objective. Consequently, technical reports generally should not present multiple competing economic scenarios or trade-off studies. While an issuer may prepare and consider these alternative studies internally, the public filing of any such study should be limited to the preferred study and contemplate the path forward, really being the main study. The idea is you've done your homework, you've looked through all the different options, and now you're telling the public how you are proceeding or how you anticipate proceeding. It's not meant to show the public all the different ways that you could proceed. So it's to think of it as you're coming up, like to talk about our diagram here, you're coming up to a fork in the road, and you need to choose a path, one clear path that you're going to take, and that's what you're going to present in your technical report. Then you sometimes get into these other situations where there's satellite deposits or phased approaches. And it can be hard for issuers to stick to one economic scenario in certain circumstances. For example, there are situations where an issuer may have a satellite deposit or wish to expand on the project in the main study in phases, such as adding an underground mine after an open pit or adding additional processing capabilities. Oftentimes, these additional or expansion studies, we call them add-on studies, have not been completed at the same level or certainty as the main study. And if so, the issuer tries to present the add-on study, for example, a PA level study in the same report as the main study. For example, which could be at like a PFS level. This is considered problematic again because all the studies are meant to be independent and discrete, and regulators would view this as potentially misleading. Why? Well, one of the issues with combining a PA like level add-on study with a feasibility study or pre-feasibility mainline study is that Section 2.31B of 43101 and 2.33 of the National Instrument prohibit inferred mineral resources from being included in pre-feasibility or feasibility study level reports. If you remember what Maria was saying, those reports define reserves, where if you're doing a PEA, it's usually based off of resources. And so by combining these things together, people might assume that the potential viability of these projects is more at a viability type level. Again, the idea is that a path has been chosen and a path leads to results. Once a path is chosen, there's not meant to be shortcuts or routes to be like taken around this.
So let's break this down a little bit with the legal jargon so that you can understand where the prohibition comes from. So Alex mentioned section 2.31B of 43101, and that's what you have on the screen right now. This essentially says that an issuer must not disclose the results of an economic analysis that includes or is based on inferred mineral resources. So this means that there can be no public disclosure of the economic analysis, cash flow models, and production rates that combine or integrate the outcomes based on mineral reserves with the outcomes that are based wholly or in part on inferred mineral resources. And on the face, this looks like you cannot have inferred anything based on inferred mineral resources in any study. But then we take a look at 2.33, which Alex also mentioned. I don't propose to read this whole thing, it's just legal jargon, but essentially what it says is that, yes, you cannot have an economic assessment based on inferred mineral resources unless A, B, and C are true. So this is saying that a PEA may include an economic analysis that is based on inferred mineral resources if you have this cautionary language included. In A, you also have some additional cautionary language in B saying that the preliminary economic assessment and any qualifications and assumptions made by the qualified person, you have the basis for that described, and the impact is also described. So those two sections of 43101 taken together are the reason why the PEA is the only study which can be based on inferred mineral resources, and the reason why there is a prohibition from including inferred mineral resources in a PFS or an FS level study. Inferred mineral resources are only permitted in PEAs that are independent of a PFS, FS, or life of mine plan. If the disclosure in a PEA appears to be combining, updating, modifying, or adding to a PFS or an FS or a life of mine plan, then there is a concern that the issuer may be breaching 43101. So you can't have them both in one report. Going back to what Alex mentioned about the add-on study discussion, where there is an add-on study situation, regulators have concerns that the add-on study might be at too early of a stage and should be further refined before it can be included with the main study of the report. Essentially, can't have this PEA study in the same report as the FS or PFS, even if it is add-on.
So taking a step back, in the alternative, the issuers may be able to rescope an advanced stage project, in other words, the main study, based on new information or alternative production scenarios, such that both the main study and the add-on study would be reflected in a PEA. What does the rescoping look like? Well, mining issuers also need to be able to take a step back to rescope the advanced stage project based on the new information. Therefore, a study that includes economic analysis of the potential viability of mineral resources that is done currently with or as part of a pre-feasibility study or a feasibility study is not, in the view of regulators, a PEA if it has a net effect of incorporating inferred mineral resources into the PFS or FS, even as a sensitivity analysis, updates or adds to or modifies the PFS or FS to include more optimistic assumptions and parameters not supported by the original study, or is completed at the level of a PFS or FS study. So really the idea is you're taking either a complete step back and moving everything back to the PEA level, or you're staying at the feasibility or pre-feasibility study level, and that newer information might not be ready to be included in that bigger report. So really the devil is really in the details. Issuers have successfully threaded the needle in order to add an add-on study at a PEA level in item 24 of the report, which is the other relevant data and information. In these instances are very fact dependent and involving the nature of development of or materiality related to the main study. To comply with section 2.31b and 2.33 of National Instrument 43-101, the disclosure of such an add-on study had a separate analysis that was not combined or integrated with the economics, mine life, and cash flows from the mineral reserve of the main study. Essentially, the add-on study was treated as its own project, with no production phasing, OPEX, CAPEX, or input from the main study. In the case of a producing property where OPEX and CAPEX are already known, navigating the approach is complex and close analysis is required to ensure the approach aligns with the requirements of National Instrument 43-101. The key is to ensure that the add-on study remains a conceptual level study, as the issuer is likely to have a higher level of confidence in costs and processing details from the main study. And as such, the issuer runs the risk that the add-on study is really a proxy for a full PFS or FS. It is more often the case that issuers might not be prepared to integrate the add-on study with the main study and should just hold off until that add-on study is at an acceptable level that can be combined.
So what happens when things go wrong? As we said, the devil is in the details, and Alex explained a little bit about how the details are important in making this work in your technical report. But if you get those details wrong, there are consequences, and this screen shows just some of those. Regulators such as the Ontario Securities Commission and the British Columbia Securities Commission conduct reviews on technical reports for various reasons. Unfortunately, many issuers have had to revise and refile their technical reports following these reviews because the commissions find non-compliance with 43-101. This slide shows snippets of some recent issuers who have been required by the OSC to revise and refile their technical reports. The OSC names and shames these issuers publicly on their refilings and errors website, which you can go to and take a look at. The British Columbia Securities Commission does not similarly publicly name the non-compliant, but still conducts these kinds of reviews and still requires issuers to revise and refile technical reports for non-compliance. It is especially important to be mindful of compliance in the circumstances of a short form prospectus, as that is often where issuers are caught for deviations in the rules. It can have a negative effect on a lot of questions in the chat, and we'll get to those. But first, this is our last kind of portion of the presentation. This is a case study. It is made up. The names are fake. It's based on a true story, but the names are all fake. The numbers are fake, and it's just a thinking exercise for everybody on this call today. So here is a case study of where an issuer, Unlucky Strike Gold Corp, was forced to retract their disclosure and refile their technical report. Over the next few slides, we'll show you more excerpts from this press release that you see on the screen. Take a good look at the disclosure and think about why this company got in trouble based on what we've told you today in this presentation. So let's just take a minute to read it. Here we see that Unlucky Strike has completed and filed a technical report on their Unlucky Complex. The report outlines a PFS, pre-feasibility study, case scenario for the whole complex. It also outlines a PEA case scenario over just their Ravens and Friday the 13th deposits. So hopefully you can already start to see why the regulators found this to be problematic just based off the first paragraph of this press release. Here's another excerpt. So as you can see, they've presented two cases. They've got, here's what happens when, here's our case scenario, pre-feasibility. This is one route. Here's another route, PEA case scenario, and they're being compared here. It's all in one technical report. This is another snippet from the press release. So they're saying they've acquired the complex in 2010. Since the acquisition, they've had so much cash flow. Now they're looking to generate significant value. So the PFS case generates this much, while the PEA case generates this. So they have clearly two competing economic scenarios based on two different levels of study in one report. They did, though, include this cautionary note. So you may recall we've spoken about cautionary language that is required to be included when you're disclosing anything based on inferred resources. This was not enough to save them from having to refile their technical report. The regulators were still not happy. So that brings us to the end of our slides. Alex, I don't know if you had anything to add on the case study, but if not, we can then turn to questions.
Yeah, no, I think that's good. I think really where, just to kind of talk about where we've seen people be successful with these situations is when there truly is like a satellite deposit that could be distinct. We've seen companies with maybe an open pit mine and then an underground mine that is completely separate, not going underneath, but maybe on a different part of the property. And they've been able to include in section 24 a PA level study on this other deposit on the basis that it isn't necessarily material to the overall project yet, and it's going to have its own capex and OpEx, and it's not going to be kind of factored into the production through the mill. It's going to be treated completely separate as a day zero situation. In most cases, the other approach would be we'll just wait for that study's done to a more pre-feasibility or feasibility study and then just factor it in. So it really just kind of depends on timing and how separate and distinct the aspects of the project are. But yeah, we're happy to see a lot of questions in the chat. I don't know how you want to do this, Andrea. Are you going to read us the questions or?
Yeah, sure. I will attempt to read the questions and hopefully I capture everything. The first question that came up, I'm not sure if I'm going to be able to capture it, but it says the pre-feasibility definition for an engineering study is the study of more than one scenario that would be analyzed to define which option is going to be the one developed on the feasibility study. How does the new mining company, how are they going to disclose the 2 or 3 alternative study during scoping level or pre-feas?
So I think again, if I'm understanding this correctly, I'm looking at the definition and I see like the idea of the pre-feasibility study is that you're going and you're exploring potentially these different options. However, the final summary or technical report is meant to include the preferred mining method. So you've done the work and you're disclosing the chosen path forward. And so I think that's the distinction here, that they want you to pick the chosen path forward. You're not necessarily supposed to show all the background work that you've done in the tech report. It's supposed to be a summary of how you're going to proceed.
Perhaps I think Juan is on the line. Here, let me try to unmute him.
Hello.
Okay. Yep.
Can you guys hear me?
Yes.
Well, thank you very much for the excellent presentation and this detailed analysis on how to present these cases. So let's assume that a company is developing pre-feasibility studies, scoping level studies, and they end up with 3 scenarios. And now they are developing a pre-feasibility case where they study the 3 scenarios. So with that information, with the pre-feasibility study scenarios, the company decides to file an I-43-101. But the 3 scenarios are still not taken through feasibility study. If they would be disclosing an I-43-101 after the feasibility study is finished, they would have only 1 scenario. But let's assume they're at pre-feasibility level, and they ended up the pre-feasibility study, and they had 3 different scenarios, not just for mining, but also for mineral processing. So how they do manage to get a I-43-101 with that pre-feasibility study information to inform only 1 scenario? What would be the route for that?
So if I understand the question correctly, it'd be 3 studies that would be done, like it would be one or the other. It's not a phased approach, right? It's just there's 3 different options in terms of moving forward. I think that was the question. Sorry, I don't know if you're on mute now, but if the question is that it'd be 3 different options in terms of moving forward, what would you present? I think the answer would be you'd have to pick. The company would pick an option, and that would be what they present in their 43-101 report. You can only have 1 report too, so you wouldn't put out 3 different reports or 3 different options within that report. And the newest report supersedes or replaces the older reports. So you're not supposed to kind of still talk about the old studies. You pick your preferred option, the most likely option that you would be trying to finance or move forward with.
Okay, thank you. I'll just move on to the next question. How does this impact sensitivity analysis of the singular mineralization and growth of the resource or reserve?
I think generally speaking, the sensitivity analysis is looking at changes in, like you have your preferred approach, and then you're looking at changes in the price, like CapEx, OpEx, other factors. I don't think you would do sensitivity with respect to alternative studies. So again, I don't know if that answers the question or not, but I think the purpose is you pick a study and then you're doing sensitivity analysis on that study, not sensitivity by looking at different approaches.
That makes sense. If a Canadian listed company has a property underdeveloped in, say, Australia, which has its own reporting regime, can those studies be used with Canadian regulators in lieu of a separate and potentially redundant 43-101?
So kind of off topic for, I guess, this conversation, but I believe you do have to do reconciliations if you're gonna do use like a JORC or a different reporting standard. You would need to reconcile it to the Canadian reporting requirements. I will say I haven't primed myself on that answer.
No worries. Okay, regulators have stated that only one NI 43-101 report can be current. How do you then demonstrate options, for example, transitioning to the underground without including them in the single report? There seems to be a major disconnect. That's the comment.
Yeah, so the options are always a tricky one. you sometimes see people have bigger projects, maybe a PEA level, and then the projects get narrowed down at the PFS level or the FS level. Once you've done that, you're not supposed to talk about the bigger project per se, unless it's all in that same report. Like the idea is that that current report supersedes everything else. So that might eliminate your ability to talk about the bigger project, assuming it was done correctly. The way that I've seen people do it, like I say, is if they had a true satellite deposit where it be developed in a different way, or at least they go through and do the economic process of developing it in a separate way. So maybe you have a open pit project on one side of the property, and then several kilometers away from that, you have maybe an underground mine or a completely different study that you, or I guess deposit that you might develop in the future. So in those situations, you might be able to wall it off if it's not material to the main project in item 24. But otherwise, the idea is you're doing it all as one study. You can do that one study as a phased approach, like there's no issue there. But again, it all needs to be done at the same level.
Okay. One question here, can you please provide an example where a second economic scenario was presented correctly?
So the example I'm mentioning is one. I don't want to give out names because we have clients, and in those situations we consulted with the regulators. There are situations out there. It really, I think if you want to look, we could talk outside of this. But I do think if you look in section 24, that's usually where you see this happen. People do it as kind of a other project, and it's completely walled off. So like it has its own capex, its own opex, its own life of mine. The feed's not mixed together. It's really treated as a completely separate project. And there's a lot of examples where people haven't done this right, where they might have a lower level study and they combine it in with the life of mine plan or other things of the main deposit. And that's where we've seen people get in trouble. We've seen regulators stop prospectuses. We've seen other problems. It really is a threading the needle or the devil in the detail, as I've been told.
A provocative question here. Which is the greater challenge today? Confused investors reading multiple plans or failure of mining companies to change the single bad plan?
It's an interesting situation. I guess there's the new 43-101, which some of the early rules have kind of come out. People are looking at. Again, I haven't fully digested it yet, but it seems like there might be an opening to do multiple studies. Again, I might be saying this completely wrong if there's any regulators on the phone. But it is interesting because a lot of people don't like the fact they can only have the one study. And so I don't know where this is going to end up. But it is a hot topic and an area that regulators have taken note of.
I'm sure you've covered this. There's a question here. Can you have the main project at a feasibility study level with reserves and a satellite deposit that is done at a pre-feasibility level? And then you can combine those reserves into an integrated mine plan and economic analysis.
So I think the answer there would be take a step back and do it all at the pre-feasibility study level. Like it would all be, because you wouldn't have enough details or data to have it at the feasibility study level. But again, you're adding reserves to reserves, so I don't see an issue with that. How you characterize the report is probably the bigger question. Probably what you would do is you step back, call it all a pre-feasibility study, and be able to lump it all together.
Okay. I think I've tried to capture all of the questions there. I don't see anybody typing. So perhaps I know we don't have much time left. Perhaps I'll leave it there. Okay, well, thank you very much. Big sincere thanks to Alex and Maria from Cassels, Brock, and Blackwell for your informative and engaging presentation and answering the Q&A. Thanks also to all the participants for joining us today. And again, a big thank you to our sponsor, IAMGold, for making this webinar possible. If you're not already on our email list and would like to receive notifications about future MES events, please go to our website, CIMMES.org, to sign up. Please be assured that your privacy is our priority. Your information will stay within MES and CIM. We look forward to seeing you again in the fall at one of our upcoming events. Thank you and have a great day.
Yeah, thanks everyone, and we're happy to answer questions offline. But yeah, thank you all for joining.